morning, everyone. Thank you for joining us in this panel, especially with all the special security device due to the King visit and everything that is going on in Madrid this week. As you know, the panel is called Liquidity as an Ecosystem Catalyst, and that's precisely, what we want to talk about. Basically, liquidity for startups and for founders, many times has a negative connotation, many times, it's the exit, it's the end of the story, and we just want to challenge that and, with concrete examples, show that it can be a continuation of a great story and that recycles capital, talent, and investment into the ecosystem. Basically, when ecosystems lack liquidity, key employees cannot realize their capital gains, founders are locked in companies for too long, there is a lot of exhaustion, and there is, a lack of, international focus in that ecosystem. Basically, we will talk about types of investors and types of potential exits, like, IPO, M&A, secondaries, and that kind of stuff. I am Juan Venegas, as said. I head the M&A, tech M&A team at Arcano Partners. We're an independent investment bank with 15 billion AUMs under management and the largest M&A team on site in Spain. And I have the luxury of having with me Daniela, who has been a CFO, has been a founder, has been an executive in large companies, and co-founded one of the first Latin American unicorns. So it's a real pleasure having you here with us. And we also have Fernando, who also has been an executive for large corporates such as Citi and Santander, and now runs Neobank, which is a digital bank in Brazil trusted by dozens of millions of customers. So it is a great story. I think the first question is actually why liquidity is important. No, there was we had a preparation meeting the other day, and basically Daniela said to me a sentence that struck me a bit, that it was, without liquidity, there is no ecosystem. No, basically was your sentence. So based on your experience as a co-founder and now as an advisor with your independent boutique, why is liquidity so important? And why do you push liquidity, especially in an environment where you operate like Latin America, that is not as, the liquidity or the most liquid environment on earth? Why do you think it's important?
First of all, thank you to South Summit for the invitation. So I think that liquidity is not the result, but it's the fuel. So for me, there's like a very important word, there's no free lunch. So if you are an LP as an investor in a VC and you don't get back your liquidity, somebody is paying the party, So if the families that invest, the governments that invest in VCs do not get their money back, they won't put their asset allocation in VC again. So what we need to understand in VC is that we are competing in the asset allocation world. So if in VC we do not get the returns that private equity does, like any other asset class, there won't be ecosystem. So it's really important to understand, from 2021 until now, how liquidity in LATAM, Spain, maybe not US, has gone down, especially in the scale-up scenario. So if we as ecosystem, we are not responsible on getting back on selling companies, doing M&As, there won't be liquidity, so there won't be any funds to finance those scale-ups, those startups, growth. So that's why it's really important, liquidity.
Very good. I mean, it's a very, important point. Us, for example, at Arcano, out of the 15 billion we hold, virtually zero was invested in venture capital like 5, 6, 7 years ago, and today we have between 5 and 10 of our assets are invested in VC, and that is because, basically we're getting our money back and liquidity is flowing. Fernando, from your point of view, you run a company today that with a sophisticated cap table, that has been changing over time through the cycle. You've been through, many market environments. Why do you think in a sophisticated company like yours, a bank-regulated company, liquidity can align shareholders and be important for both founders and investors?
it's a very good provocation actually, because as Daniela mentioned, liquidity is a must. It's critical for the ecosystem to continue going, right? And there are different needs for each type of investors, and that becomes the complexity, right? Neon today has very different ranges of investors, from early seeds, VCs, to private equities, to development bank like the IFC, and traditional banks that are there more like buy and hold. So in theory, that brings a very good know-how and expertise for the company, but also adds a lot of complexity because there are conflict of multiple interests. Do you want to sell the company? At what price? When do you want to sell the company? Should you do one more round? So the beauty of that is diversity of thinking, but you really need to have a strong board and a strong management to ensure that the company's objective is always put at first, being managed different, I would say, points of view and different wish on that.
Thank you, Fernando. So look, I think now we can treat one of the potential exit routes, that is IPO. No, IPO is very aspirational. It's very, public for the founder and the entrepreneur. You become instantly famous. You ring the bell. Your shares start trading. You got the market scrutiny, but it's also, it can be potentially dangerous due to short-term challenges, decisions, costs, and precisely the fact that anything that the market perceives that you're doing wrong can have a direct impact in valuation. No? So I think, Fernando, again, you've been through many market cycles, many different types of companies, and now you run a very significant business in Brazil. Why do you think, or for which kind of business you feel IPO is the correct route to go through the liquidity path, and for which can be a trap?
Yeah, that's interesting because I sold some companies and I did one IPO, and I think that almost every founder dreams of IPO one day, right? And I think that, and I was part of that, and I think that a lot of that comes from how sexy is an IPO. You dream of being a NASDAQ, and that's a lot of ego and a lot of, check the box that your company actually succeeded, right? That IPO is an event that say, wow, you actually did it, right? But more and more I think about that very specific situations require an IPO, right? There are many other ways to add liquidity. You can have another round. You can continue bringing the proceeds of the profitable to fuel your company. There are secondaries where founders or other investors can cash in and move on. So the advice that I have is that you need to understand exactly what do you need the IPO for. What is the size of your company for the IPO? I think these days, if your company's value is less than $3 to $4 billion, which most likely you're gonna raise around $1 billion, it's almost a no-go. 6, 7 years ago, smaller companies were doing that, especially in the US. Of course, there are different ways to count for that. So if you don't have a maturity enough, and if these proceeds will not either fulfill a huge additional expense or international or the market, you need to think twice, because you need to be able to work on all the trade-offs that you're going to have to IPO. And then trade-offs means you used to control 100% of your destiny. You don't control it anymore. You used to have a very long-term path. IPO, you manage by the quarter. There are different requirements for an IPO that sometimes you need to do, which sacrifice your long-term. So in a way, what I want to say is that IPO is, of course, is still a very important path of liquidity, but one needs to be very careful what you need for, and if it's something that it's for the company or if it's for yourself as a founder or an investor.
Very good. What do you tell founders and entrepreneurs that you speak with every day, that probably they all come with the IPO dream to you? What do you tell them about the IPO?
I think it's like an illusion. Like if we see data from last year, there were like more than 10,000 deals in M&A worldwide and only 500 IPOs. So where do you have the liquidity? Where's liquidity? First, we need to understand that US is like 27% of the world GDP. Spain is 1.5. When they say Europe, it's like 17%, but it's so fragmented that liquidity is basically in US and China. How do we access China? It's really hard for the whole world. So we need to understand, as Fernando mentions, that when you do an IPO, it's only if you are a real global company. And now, like with AI, we're the real global companies in the incumbents, you know, like US. So what's the reality for us in Europe, like fragmented Europe, in LATAM? Probably it's to understand what's your real exit path. So why do you create a company that is VC-backed? Because you need to sell it. You need to give that liquidity back. The VCs need to give that liquidity back to their LPs. So we really need to, one of the first questions I always ask entrepreneurs is, what do you want to do with your company? What's your path? Not the playbook, like what do VCs tell you? You as a founder, how do you understand your company? Which are your possible buyers? From the day you start the company, it's like, why are you VC-backed? It's easy money, of course. But then how do you sell it? And for the founder, it's kind of a free ride, you know. It's like, we were discussing with Benjamin from SeedStars before the panel, it's sometimes you are financing your lifestyle. But for the VC, there's a fiduciary responsibility with their LPs. So IPO, it's like really hard, and you don't manage your destiny. As you were telling Fernando, yesterday, Nubank's stock price went down like 10%, or the day before yesterday. The market went down, but also there was a change in the CFO, and the perception of the market is that there's a change. So your stock went down in a day like 10%. So your destiny is not in your hands. You can have like the best results, but if the market perception is that your stock is worth less than what it's worth today, it will go down.
It will.
So that's...
Thank you very much. I mean, I think it very much... Yeah, Fernando.
Just one reflection. I think it's, again, it's not good or bad, but an IPO also may change a lot the culture of your company and the type of talent that you bring to your company. And again, you can always manage to continue that, but it's very challenging because in the beginning, you have a lot of people that goes there from the long term. A lot of people that are really coming for the passion for the vision of the companies, for the values of the country, for the culture. When you go for the IPO, it's much more difficult to sustain that because it becomes almost like a transaction point of view, and it becomes, you know, fluctuation. So you're not gonna get like a stock price or SOP because you're gonna be public traded. So you also need to consider how the IPO or how the liquidity event will affect the type of culture that you want to build on your company.
Thank you very much. I mean, I think the other traditional route for liquidity is M&A. No? You are every day advising, as we are, you know, companies in, you know, or founders or investors in trying to acquire or divest from other companies. I mean, there's many investors or founders that feel that they've done a couple of rounds, capital rounds, they have a successful business, and they think that an M&A process is going to be easy. No? But then, you know, they go into the M&A process and, you know, it's pretty challenging, it's tough, it can pose a lot of, you know, psychological stress, it can affect the business, so you really need to be ready ahead of launching an M&A process. Now, what do you tell your founders they need to know ahead of, you know, pressing the button?
I think that founders, we have like the perception that selling your company is really easy because there were like examples in 2021, like it was kind of easier to sell a company. There was like a lot of liquidity in LATAM. So it was like the due diligence was not so deep. So you were able to sell a company in like 6 months. Nowadays, I'm doing kind of a large M&A for Latin, like $100 million. We're working on it like for a year. Yesterday we sent the binding offer, but it has been like a pain for the founder. First, focus from the team just in selling the company, like not operating the company. So then you have like this trade-off. If you do not have enough money for your company to run while you're doing the M&A, you're going to be in trouble because probably you will have to sell it like a forced sell because there's no option because you were not like selling revenue creating revenue for the company. So first, take into account that at least it will take a year. Then, do you have like the correct processes, audited financials? Like for a startup, it's like, do you audit your financial? It's like, what? Like what? Who audits? Like, first start from the basic. Like have the right processes, audited team, contingencies. Like as you know, I advise founders. I'm advising a company in Miami. So we are planning to sell the company like in 1.5 years. We're starting like to have like an internal audit, like prepare the company to sell, prepare the team to sell. Who's gonna be the team that will be doing, like managing this process and who will be still operating? So there's a lot of issues that probably like a corporate, it's like they do have the process and everything, so it's easier to sell. In startups, you need to build first some things that you don't have, and then start the M&A. So,
yeah, and there's a very interesting topic that you have seen, Fernando, many times, especially when there are critical or regulated sectors, there is regulatory approvals. No? So sometimes you have sold your company, but then you got competition for indirect investment in Europe, for example, or you get approval from other regulators such as local central banks or market supervisors. So there's sometimes an interim period where you have actually sold your company, but your company is still yours. No? And there is someone that has bought the company, but still the company is not completely owned by them. How do you face that transition period, and what kind of challenges you've seen?
That's a good point. And then I mentioned that yesterday you're doing the binding, right? And binding is something that, as an executive, as a founder, as an investor, it's like, wow, great, check, done. It starts at very, very challenging parts of the journey after that. First, because usually after you have the binding, you have many things in terms of contract that will take, especially in financial institutions, let's say 5-6 months. I sold the company to Nubank, and it took 5 months, which was short. And then it was the anti-competitive laws and the central bank, which took around 9 months. So almost a year and a half from the moment that we thought that we sold the company to the moment that the money actually received in the account. And that a year and a half maybe was one of the most challenging moments of my professional life, because there's a lot of anxiety on the company that has been bought, a lot of the insecurities on the employees, like, wow, what's going to happen? The new company is buying, am I being fired or not? And I'm going to have a great life or not? The current shareholders have sold the company, but has not sold yet. So they don't know how to, why should I care investing additional money if something that technically we have sold already? The company that has bought wants you to full gasoline to continue growing because they want to get the company later. So there are a lot of moving parts, a lot of conflict of interest. And then you have the CEO, you have the management trying to negotiate those things. So I think that the main message for everyone is that deals take way, way longer than you anticipated. Successful deals, I'm not even talking about bad deals that sometimes doesn't happen after a year, but successful deals is much more complex than what you think. And once you sell the business, many times, a lot of the KPIs or the reasons to believe on the deal end up to be lower than what you anticipated. Still very important. Sometimes it's the difference between a company that is growing like this and the company that will shy. But there is a lot of complexity involved on that. It's not like, wow, 10 billion company, 10 billion, let's do here 25. It's not as Excel might think, right?
Thank you very much. I mean, and then, there's another message that we want to challenge today, that is liquidity is the exit. No, it's the end of the road. No, so, and actually we have a very concrete example here. So Danielle is still a shareholder of his, the company she founded long ago. And basically, as a founder, you have a fiduciary duty and you have a liquidity, responsibility to your investors. That you know that they also have to return the capital to their own investors. So there are ways to kind of push for liquidity without exiting your own business. And that's, we want to, the most usual one are secondary deals. No? So a deal where a tranche of the company is sold, and it can be with or without a founder tranche or shareholder tranche. No? People go and speak with you, I mean, for like liquidity events. How do you treat secondaries when you speak with them? No? And precisely in your personal case too.
Yeah. I think secondaries are like 6 times the IPO market. So it's a huge market, probably an unknown market. I started to understand about secondaries when I had to sell mine, so like 5 years ago. So first, secondaries are liquidity for pre-seed and seed funds. So they're like a really important part of the ecosystem. And what's one of the most important things about secondaries and about the whole ecosystem, it's valuation. So if you don't have like the right valuation, there's no liquidity, there's no secondaries. Good news on secondaries, like in 2023, the discount on secondaries were around 50%, even in the US. Now, average secondaries discounts are 12%. For LATAM, probably they're higher. They're like almost no liquidity for secondaries in LATAM. It's really, really hard. A friend of mine just opened a fund for secondaries like a year and a half ago. But it's unknown for the founders, unknown for some seed stage VCs how to sell secondaries, because you have to have a very close relationship with big funds who will be able to find your secondaries. So when you start also the game, you need to understand, again, what's your liquidity play? Like not what's your funding play only, what's your liquidity play? So I think that's one of the most important questions. And on liquidity, the second most important question is valuation. So it's not possible for companies that they sell like 5 million, they're worth 70 million, like 70% EBITDA. So a correction in valuations also needs to be done.
Very good. Yeah, thank you very much. And I think, as a final remark too.
Can I just, one point I think you need to be careful on secondary. There's a secondary for, for the existing shareholders, right? And many times we clean up your cap table because there are a lot of small investors, so you do a secondary, so you move it. But there is one point to be, it's important about is when you do a secondary for your current employees, the founders. On one side, this is good because it removes the anxiety to the liquidity event, so you cash in a little bit, but it can be very dangerous. Because if you do too much of the secondary, the founder, the management is like, you know what? I'm good.
I'm done.
I'm done. So that passion to really go, and you've been a founder, the resilience is one of the most important things. If you remove that with secondary, the company is over.
Awesome. I mean, I think, just as a final remark, there is one thing that founders need to, bear in mind. That is, there are such a different number of types of investors in the market. No? So you've got trade buyers, you've got financial sponsors, you've got venture capitals, you've got family offices, search funds. There's a ton of exit routes. No? So basically, Fernando, I mean, running like a sophisticated cap table. Your company could be acquired or, in full or in part by many different parts of types of investors. How do you normally both advise, people on what kind of route you need to follow to attract the best potential investor for you?
Yeah, I mean, there are phases, right? The first is any type of money is important, right? I need the money, I need the seeds, I need to start with. But then we move to a second part, which the type of money counts, right? What we are right now, the fundraising that we've been is we wanted to have the VCs and the Ps. We want to have an important bank for that, but the last round we brought IFC, the Banco Mundial, and the DEG, which is the development bank in Germany, because we wanted to have the type of quality stamp on our story that, these guys have been there for a year doing due diligence about fair lending practice, quality of the customers, ESG, a lot of those things that force us to be very, very strong on that. So there's also a way to see what these particular investors will bring to you besides money. Is smart, is expertise, is the branding. And I think that's the beauty of having a diverse source of investment in your cap table. Right?
Thank you very much. I think time is up, but ahead of anyone having a question, I think there's 3 key messages we want you to take away from the panel. First is that liquidity is not negative, it's necessary for the ecosystem. It recycles capital and talent back into the system, and it allows the next wave of companies to be created. There are plenty of exit routes, IPOs, M&As, secondaries, and different types of investors, and you need to plan ahead of any liquidity event in order to be successful. Thank you very much. Anyone has a question around?
Hello. Hello. Yeah. This is especially for Daniela, as you obviously you have been an entrepreneur and a founder. What do you think, in your view, it's worse? Raising capital from the wrong investor, meaning that you don't get along well at some point, you're not aligned on the strategy, or realizing that you have sold the company too early?
I think it always depends. Like, an investor for me is a marriage. So sleeping with the wrong person, it's hard. But selling too early, you never know, you sold it. Like, there's no what if. What if it will have a bigger value in the future, but then COVID hit? So for me, everything is perfect. If you sold it, like as a founder, if you sold it, you're always able to do something else. Like, founders are crazy of building something else. So for me, it's better for the whole ecosystem to sell something rather than stay, just for the probability that it would be worth more in the future. And that probability, it's so low. And again, it's valuations. It's easier to sell something at 100 million than to have something that's worth 1.5. So what are the options to sell something at 1.5 billion, and who are the possible buyers of 1.5 billion? So that answers.
Maybe I'm going to try to, selling earlier, you leave money on the table, you get less money than you wanted. But a wrong investor can destroy your company.